So welcome again to this particular session, and we were at point number 4, identifying the net assets taken over of acquiry by acquirers. So quite obviously now you will have to identify the net assets which you have taken over of the acquiry company. Even though I have written identify, it automatically also means that identifying the net assets, they're recognizing them and measuring them, correct? So you need to have a bit of idea regarding that. So here some important points are there. For example, you write here all assets and liabilities, all assets and liabilities which you have taken over, correct? All assets and liabilities of acquiry company are taken over at, see here what I am writing, at fair value. That means you have to take them and record them at fair value. Of course, on the date of acquisition, correct? So I need not require to write on the date of acquisition, because on the date of acquisition you are doing the accounting, it is implied. Second point, there are some important points which you need to take care of. For example, non-current asset. Non-current means which are not current asset. Non-current assets held for sale. Non-current asset held for sale. Suppose if you are taking over an acquiry company, and acquiry company is having some non-current asset which it has kept for sale. In the balance sheet, non-current asset held for sale are represented as separate line item, correct? So if acquiry company are having non-current asset which are held for sale, then non-current asset held for sale of acquiry company are taken over. You are going to take them, you are taken over at its, let me write with red pen, at its fair value less cost of disposal, we call it cost of disposal. Actually, Ind AS 105 states that non-current asset held for sale are measured at fair value less cost of sale. Even though this standard says that most of the assets which are going to take over of your acquiry company should be recorded at fair value, but you can say it is a sort of exception, correct, as far as measurement rule is concerned, because this time you are taking over non-current asset, but you are not measuring them purely at fair value. You are going to measure them at fair value less cost of disposal. Suppose non-current assets have been represented in the balance sheet at 1 lakh, and today if I am going to sell them, I will have to incur 10,000 on disposal. So fair value less cost of disposal will be 1 lakh minus 10,000. That means at 90,000 I am going to recognize them. Is it clear to you? I will keep this sheet over here now. Similarly, there may be some chances that acquiry company might be having some assets which they might have not recorded, correct? Which they might have not recorded, but still you will have to record the same. This is the facet of this standard. Intangible assets that meet recognition criteria, as per Ind AS 38, but are not recorded but are not recorded by acquiring company, by acquiring company, comma, shall also be taken over. So you are going to take them over, shall also be taken over and recognize at fair value on the date of acquisition. So this is another important point, that even though acquiring company might have not recorded such assets, but they are meeting the recognition criteria as laid out under Ind AS 36, Ind AS 38, sorry. So you will consider those assets. Examples of such assets are like internally generated examples. Internally generated uh, internally generated customer list. Suppose you are taking a startup company, so they might be having internally generated asset, customer relationship, comma, internally generated patents, etc. So point is that even though acquiry hasn't recognized them, and if you are taking over the acquiry, then quite obviously you will have to recognize and measure them. Besides contingent liability of acquiring company. So even though acquiring company might have some contingent liability are those liabilities which are not reflected in the what we call liability side, rather by way of notes. That means they are not considered as actual liability, because whether they would be actual liability or not, it depends upon the future course of action. Contingent liability, as we know, accounting standard AS 29 and Ind AS 37 actually deal with contingent liability. Now, as per these standard, contingent liability are present obligation. Present obligation means there is some foundation upon you on the reporting date. Present obligation means an obligation on the reporting date. So on the reporting date, let us say you have some other entity might have filed a case against you, let us say, and case is still running. So on the reporting date, there is an obligation. But point is that whether cash will move out or not, that depends upon the future course of action. Now, Ind AS 37 states that if there is present obligation on the reporting date, correct, but probability of outflow of funds is remote, that means there are less chances that outflow of funds will take place. In that case, it is represented as contingent liability. It is not represented as liability. However, if probability of outflow of funds is there, it is quite high. In that case, we may consider it as liability. However, Ind AS 103 states that whether even though acquiring company is having a contingent liability, acquiring company is having a contingent liability itself shows that acquiring company is of the opinion that probability of outflow of funds is less. It is not high, it is less. That is why they have shown it as contingent liability. But Ind AS 3 states that contingent liability will have to be recognized irrespective of the fact whether probability of outflow of funds is there or not. So that is why contingent liability of acquiring company shall also be taken over. Contingent liability of acquiring company shall also be taken over, and recognized at fair value on the date of acquisition. On the date of acquisition. Correct? Actually, you can call it as an exception of recognition rule, because generally we don't recognize contingent liability. However, we have to recognize here because Ind AS 103 states. Ind AS 103 states that contingent liability will be recorded as liability irrespective of the funds, whether what we call there is probability of outflow of funds or not. We will have to recognize that liability, and we are going to recognize it at fair value. That is, whatever fair value is running on the date of acquisition. Besides, indemnification asset. Indemnification asset. Indemnification asset promised by acquiring company. Indemnification assets promised by acquiring company shall also be taken over. Shall also be taken over. Shall also be taken over. Now, what is indemnification asset? See here, let us say we are taking over company B. Company A is taking over company B. And on this date, company B is having a contingent liability of 500 lakhs. Since company B has recognized it as contingent liability, it means company B is of the opinion that probability of outflow of funds is quite slim, quite less. That is why they have considered it as a contingent liability. However, if in the opinion of company B, probability of outflow of funds would have been very high, in that case, they would have recognized it as a liability. So let us say there is a contingent liability of 500. Now, because company A is taking over company B, company A will have to take over this contingent liability. Now, company A will take over this contingent liability and it will consider it as a liability. Point is this. Now, the problem is that company A will tell company B, see, we are under pressure because of Ind AS 103, we have to take care of this particular liability. And chances are there, because it is your contingent liability, and now since we have taken over this liability, that means in case tomorrow, in case this contingent liability matures into a liability, then we may have to pay 500 lakhs, let us say. Company A is telling to B Limited, we are taking out this liability, but tomorrow if this particular liability would materialize, then who would be responsible? We would be responsible to pay 500 lakhs. So generally when contingent liability of other entity is taken over nowadays, because of Ind AS 103, an agreement also takes place between the acquirer and acquiree, whereby acquiring company gives a promise to the acquirer that tomorrow if this contingent liability would mature, we will bear 400 lakhs. We will bear 400 lakhs. Are you getting my point or not? They may give a guarantee of even 600 lakhs, what my point is. But let us say they have given a guarantee of 400 lakhs. So now A will not have any pinch in taking over this particular liability, because they will have to take over this liability because of pressure or because of guideline of Ind AS 103. This 400 lakhs which B has promised, why B has promised? B has simply told A Limited that we will compensate you. That is exactly the meaning of this 400 lakhs. Tomorrow if you will have to pay 500 lakh, we promise that we will pay you 400 lakhs. We promise you to pay 400 lakh means we take a sort of promise to compensate you, to indemnify you. So this asset will be considered as indemnification asset for company A. Are you getting my point or not? So we will recognize it at agreed value of 400 lakh. This indemnification asset will be recognized not at fair value, but it will be recognized at agreed value, whatever value they have agreed upon, let us say 400 lakh. Now suppose B Limited would have told, we would pay you 600 lakhs. Are you happy? Now A Limited will say, okay, we are very happy. But the point is that if tomorrow this liability takes place, maximum we will have to pay 500. Now, do you think in that case B Limited will give us 600 lakh? Maximum they will give us 500 lakhs. So even though if they have promised 600 lakh, point is that indemnification asset we will recognize at agreed value, but it cannot exceed the what we call amount of contingent liability. For example, if they have promised 600 lakh, at the most we can recognize it at 500 lakhs. Is it clear to you or not? So indemnification asset promised by acquiring company shall also be taken over. However, such asset cannot be recognized at a value in excess of contingent liability. So we cannot recognize them at a value which is higher than contingent liability. This is the point is. Similarly, now reacquired rights. Like licenses, franchise rights, etc., appearing in the books of acquiring shall also be taken over. At fair value. On the date of acquisition. Franchise rights, for example, let us say company A, we call it pre-existing relationship. We will talk about it when we'll take a separate section on what we call existing relationship. But at this point, it is enough to tell you that sometime what happens, we give our what we call franchise rights or licenses to other entity. Let us say we gave a license of rupees 10 lakh to company B for that you use it for 10 years. And let us say it was given 4 years back. And in the beginning of the 5th year, let us say company A acquired B Limited. This asset we gave them for 10 lakh. Out of 10 lakh, 4 years have gone by. So that means remaining value of this asset is 6 lakh. So this asset must be appearing in the books of B Limited at rupees 6 lakh. Are you getting my point or not? So now we are taking over B Limited. So we will recognize this asset, but we will recognize it at fair value. That is very important. Correct? So these are the things which you need to understand. And after this, the next step is calculation of goodwill. This is our step number 5. Calculation of goodwill or gain on bargain purchase. Gain on bargain purchase is a term which we use instead of capital reserve nowadays. Gain on bargain purchase is synonymous to capital reserve. It is a pretty long word, so I will use it GOBP, gain on bargain purchase. Correct? Gain on bargain purchase. Calculation of goodwill or gain on bargain purchase. How to compute goodwill or gain on bargain purchase? Near about 20 sections we have kept in our notes. Correct? These are our notes. And still these notes are not full. business combination notes, as you can see, and we have divided it into several sections. For example, you can see this is section 5, and similarly so on till up to 18, 19, 20 sections are there, something like this, correct? So 20 sections are almost there. Our first section also deals with calculation of goodwill, but how to compute goodwill? First thing is this. In order to compute goodwill, calculation of goodwill or gain on bargain purchase, instead of giving you any what we call formula or something like that, I'm trying to make you understand how we are going to compute the goodwill. This is very important, correct? First have a look over there, then I will write the what we call basics. Let us say there is an entity by the name of F1 Limited, and this company acquires on this date, acquires 100, acquires, let us say 80% stakes, 80% stakes of F2 Limited, correct? We got 80% of the total share capital of F2 Limited. Now, this is of course your date of acquisition. On this date of acquisition, we acquired 80%. And we decided to pay consideration. And it was agreed that we will pay you rupees 9,60,000. Rupees, okay, I will make it 9 lakh. We will pay you rupees 9 lakh. We got 80% of their share capital, and it was decided that we will pay you 9 lakh rupees for the same. We further presume that on the date of acquisition, see here, I am stretching this line, on the date of acquisition, net assets means assets minus liability. Net assets of F2 at fair value were rupees 7 lakhs. On this date, we acquired control over this particular entity, number one. Number two, on this date, on the date of acquisition, worth of net assets in terms of fair value is 7 lakh of F2 Limited. Now, how to compute the goodwill? In order to compute the goodwill, what I will have to do, first of all, I will have to check A, 100% of net identifiable asset, NIFA, net identifiable asset, 100% of net identifiable asset of acquiring company, which is F2, on the date of acquisition. When you acquired control, what was the value of net assets? What was the fair value of net assets of that company? Now, it is clearly written in the question, or in the example, should I say, 7 lakh. So, fair value of net identifiable assets of acquiring company on the date of acquisition is 7 lakh. After that, what I am going to do is, see here, less B. I will write here NCI. When here I write NCI, what does it mean? What does it mean? Before I let you know about that, let me pick up rough sheet. Here it is, the rough sheet. This is company B. This is company B, correct? In this or let us say this is company F2, the acquiring company. In acquiring company, you have acquired 80% stakes. Out of 100% of its share capital, now 80% is in your hand. So quite obviously 20% is not in your hands. What does it mean? It means whatever net assets of F2 are there, whatever net assets of F2 are there, out of that 80% now belong to you, and 20% belongs to other shareholders. 80% shares are in your hand and 20% shares are in the hands of other shareholders. Now these other shareholders are known as non-controlling interest holders. Why they are known as non-controlling interest holder? Because they are interest holders. They too have some interest here. Obviously, they also have invested in this company, so they are having some interest in it. When we say interest, means they are also having some share in the net assets of this company. When we invest in a particular entity, quite obviously we acquire the share in net assets of that particular company. So they are having interest in this company, but they are not having the control of this particular company. That is why they are known as non-controlling interest holder. Non-controlling, they are not controlling this company, but they are having the interest, non-controlling interest holder. And we are having 80%, we are controlling interest holder. We are acquirer, we are parent, you can say so. So whatever net assets of F2 are there, 20% will be considered as assets belonging to NCI and 20% will be considered as belonging to acquirer. Is it clear to you? This is what we mean by NCI. So I want to know, when I acquired the control on this particular entity, out of 7 lakh worth of net asset, what worth of asset actually belong to other shareholders? So when we say NCI, it means actually NCI, that is share of net assets, share of net assets belonging to NCI. So out of 7 lakh, because NCI is having 20% stakes, 80% stakes are in our hand. So 20% stakes quite obviously are in the hands of other shareholders who are known as non-controlling interest holder. So out of 7 lakh, now we may say that 1,40,000 worth of asset belong to NCI. Quite obviously, if I am going to subtract 140 from 7 lakh, I will be left up with 5,60,000. This 5,60,000, what does it reflect? It reflects share of F1, acquirer, share of F1 in net identifiable assets of acquiree on the date of acquisition. That means on the date of acquisition, one may say in a layman's language that acquirer got hold of this much of asset. And on this date, we got hold of this much of assets. But in order to get hold of this much of asset, how much we churned out? What was the amount of consideration? So now I am going to compare it with consideration. Less consideration. So consideration amount is 9 lakhs. Consideration amount is 9 lakhs. So if I am going to subtract 9 lakhs, I will be left up with what? I will be left up with 2,40,000. 40, it will become 6 lakh. So 3,40,000, I think. Now, because the consideration amount is more, that means you spent more than what you got. So that is why it is a loss to you. It is a capital loss to you. So it will be considered as goodwill. It will be considered as goodwill as consideration is more than share of F1 in net assets of F2. We need not require to write this much, but just for the sake of understanding. So that is how we are going to compute the amount of goodwill. That means in order to compute the amount of goodwill, first of all, I will have to keep track of the total net worth of assets which the acquiring company is having on the date of acquisition. We will consider its fair value. Out of that, we will now segregate these net assets into the share of NCI and into the share of F1, you can say so. Now, once you have the share of F1 in the net assets, then you compare it with the consideration, and then you can easily find out whether it is goodwill or what we call gain on bargain purchase. So on this note, now we move over to section 1 also. Now section 1, I've already told you we have kept near about 20 sections. Section 1. Section 1 deals with questions related to calculation of goodwill, NCI, and gain on bargain purchase. Gain on bargain purchase. Is it clear to you? Now, if you look into your question number 1, in fact, you need not require to look into it. You simply pay attention. This is section, I'm writing here 1.1. I will simply explain the question before you. Don't worry about that. Although you can look into your notes, that is not a big problem. When you will open down your notes, correct? Section 1.1, that means question number 1 of section 1. Near about 11 question we have kept over here in this section. Just pay attention. What is the theme of this particular question? In this question, it is stated that there is an entity by the name of FX Limited. FX Limited. This is an entity and it acquired 100% stakes. 100% stakes, let us say this is our date of acquisition. Let us say on this date we acquired 100% stakes of LX Limited. LX Limited will be considered as acquiring company. Correct? And we have been given in the question that in order to get 100% stake, purchase consideration or consideration amount is rupees 9,60,000 in order to purchase 100% shares of LX Limited, as we will give them 9,60,000 rupees. 9,60,000 worth of consideration. On the date of acquisition, it is also stated in the question that net assets of LX Limited, net assets of LX Limited is equal to rupees 8 lakhs. Is equal to rupees 8 lakhs. Even though fair value this time word is not written, but if it is not written, you presume that these assets are at fair value. So now, in order to compute the goodwill, what I told you, in order to compute the amount of goodwill, all we have to do is that we have to note down 100% first of all, 100%, step number A, 100% of fair value of net assets of acquiring. Okay, instead of writing LX Limited, I am writing acquiring company. So we have seen that value of their net assets on the date of acquisition is 8 lakhs. Now from here on, what I am supposed to do, I am supposed to now subtract the share of NCI. So I will write here NCI. Problem is that in this question, there is no NCI because we have acquired 100% control. So no question of other shareholders. That means whatever remaining amount is there, 8 lakh is the remaining amount. This remaining amount, of course, now belongs to acquirer. So balance reflects share of acquirer, in net assets of acquiree, of course, on the date of acquisition. So your share is 8 lakh. In order to get 8 lakh worth of net assets or hold of 8 lakh worth of asset, how much did you pay? Less consideration. We paid 9,60,000. Now you let me know whether in this case there is goodwill or gain on bargain purchase. So goodwill. Why? Because consideration is more than the amount of net assets. Is it clear to you? Net assets which are accruing to the acquirer. So this is how we are supposed to compute in it. Is it clear to you? However, question has also asked us to pass the entry. How the entry will be passed? The entry will be entry. Now I am going to pass the entry. Entry will be NIFA account debit, net identifiable asset account debit. We are taking over net identifiable asset worth 8 lakh. Then here I am going to write, actually I can write cash also, because nothing has been mentioned in the question that in what form we are discharging the purchase consideration. I can write cash, I can write capital, or simply consideration. Because nothing is mentioned in the question in what form this consideration is being paid out. So we will write here 9,60,000. Correct? There is no NCI in it. However, if there would have been NCI, I would have reflected it over here. Why? Because I have written over here 100% of the net assets of the acquiring company. And if I am writing NCI towards the credit side, that means I am deducting from this net asset share of NCI. So whatever remaining assets are there, we are now comparing it with the consideration. Obviously, we can get now goodwill or gain on bargain purchase. So in this case, balancing figure is goodwill. This is our balancing figure. Although we have already computed goodwill, 1,60,000. This entry we are going to pass on the date of acquisition. Is it clear to you or not? Now we come over to question number 1.2. As far as question number 1.2 is concerned, pay attention. Over here, what is happening? There is an entity by the name of K9 Limited. Look into your notes. This time, K9 Limited again is acquiring 100% stakes. All these questions are from your module. Names might have been changed. That's a different matter. K9 Limited acquired L5 Limited by acquiring 100% stakes. Correct? We presume this is also the date of acquisition or control. Date of control or date of acquisition are one and same thing. On this date, it is given in the question that K9 Limited will give a consideration of, give consideration this way. This time in the question it is written that K9 Limited will issue 60,000 shares. 60,000 shares of rupees 10 each, that means having a face value of 10. 60,000 shares having a face value of rupees 10. Correct? So in order to discharge the consideration, K9 Limited will offer 60,000 shares of 10 each at the rate of rupees 240. At the rate of rupees 240, that means at a premium of 230. Quite high premium. Anyway, so this is how we are going to discharge the consideration. Further, it is also given to us that on the date of acquisition, L5 Limited is having net assets. L5 is having net assets and their book value is given. Their book value is rupees 72 lakhs. However, it is also given that these net assets are having a fair value of rupees 135 lakh. 135 lakhs. It is also given in the question. Correct? It is also given in the question. So now you have to solve the question. In order to solve the question, as I told you, under step number A, we will write 100% of fair value of net assets or net identifiable asset, you may write net assets of acquiring on the date of acquisition. Although we need not require to write that on the date of acquisition time and again. It is implied because we do the computation of goodwill on the date of acquisition itself. Now I will not consider 72 lakh, I will consider 135 lakhs because we have to consider the fair value. So 135 lakh. Out of that, now I will have to subtract NCI share. Unfortunately, again, NCI is not there in this question. So 135 lakh worth of asset in entirety belong to K9, acquirer. Acquirer's share. Acquired share of net assets. Now we have to compare it with the consideration. Consideration. As far as consideration is concerned, how much consideration? 60,000 into 240. What will be, how much it will be equal to? 60,000 into 240 will be equal to how much? Let me compute. 1, 2, 3, 4, 5, 0. And 24 into 6 will be 144. So I think it is equal to 144 lakhs. Correct? Even if it is wrong, don't worry about it. Point is that concept should be absolutely crystal clear. So we may get in this case 9 lakh. So 9 lakh, because once again consideration is more than what we call acquirer share of net assets, it will be considered as goodwill. Moreover, chances of gain on bargain purchase in practical life, to be very honest with you, are very less. Correct? Most of the time you will get goodwill. Now what entry you are going to pass? Once again, question has also asked to pass the entries. So what entries you are going to pass in this case? Entry. NIFA. Net identifiable asset account debit. You have to practice it. You have to write here 100% of NIFA. 135 lakhs. Correct? Then you write here to consideration, or you can this time write share capital because this time it is given that you are offering 60,000 shares. But when you write here share capital, it is important that you have to write the nominal value. So nominal value 6 lakh, and you are offering your shares at a premium of 230, 60,000 into 230. That is 138,000. So it will be equal to 144 lakh. Then this total is nothing but your consideration. There is no NCI, but if NCI would have been there, I would have presented it over here. Then now we can compare it and get the amount of goodwill. Although we have already computed the amount of goodwill, it will be equal to 9 lakh. This is how you will have to do. Is it clear to you? Next is now 1.3. In this question, what is happening? Just pay attention. You can look into the question if you want. In this case, there is an entity by the name of A Limited acquiring B Limited, and given to us that this company is acquiring 80% worth of control, 80% worth of stakes, correct? Also given to us that A Limited will pay consideration of rupees 9,60,000. Just wait, let me check sometime. No, it's okay. Consideration is rupees 9,60,000. Correct? Further, it is also given that on the date of acquisition, B Limited is having net assets at a fair value of rupees 8 lakhs. at a fair value of rupees 8 lakhs. Only difference is that this time we are having NCI also, correct? So that should not be a big issue for you. It should be almost like a cup of coffee for you. Solution. A, 100% of fair value of net asset or net identifiable assets of acquiring company B Limited on the date of acquisition, if you want to write. So in this case, 8 lakh is the 100% value less NCI share. Now, NCI share will be 20% of 8 lakhs. 20% of 8 lakhs, correct? 1,60,000. It is 1,60,000. We are left up with 6,40,000. This 6,40,000 represents share of net assets of acquirer, that is A Limited. And how much consideration we are paying? Less consideration. We are paying a consideration of rupees 9,60,000. 9,60,000. We are left up with 3,20,000. This 3,20,000 without an iota of doubt will be considered as goodwill. Correct? It will be considered as goodwill. Now, before I move further, actually through this particular question, I just want to bring to your notice one important facet. And this is very, very important. The concept is that measurement of NCI, an entity can measure NCI at fair value or on proportionate share basis. NCI can be measured on fair value basis, or on proportionate share of net assets basis. Proportionate share of net asset basis. Proportionate share of net assets basis. Now, proportionate share of net assets basis, it's a pretty long sentence or long word, so I will use proportionate share, PSNA. In all the 3 questions which we have done so far with respect to computation of goodwill, I computed NCI on PSNA basis, proportionate share of net assets basis. Although NCI can be computed on fair value basis. If question is silent, it is entirely your discretion, because entity has the choice whether they want to reflect NCI at fair value or on proportionate share of net assets basis. Quite obviously, when we will compute the NCI on fair value basis, then we will have a different goodwill. And if I am going to compute it on proportionate share of basis, then again we will have a different goodwill, because the value of NCI will change. For example, in this question, now I will compute NCI on fair value basis. Here we have used proportionate share of net assets basis, because we have simply taken the proportion of the net asset of NCI. So now if suppose I am going to compute NCI on fair value basis, now what will happen? NCI on fair value basis. NCI on fair value basis. Suppose I compute now NCI on fair value basis, what will happen? First of all, how I am going to compute the fair value of NCI? It is easy to compute the value of NCI on the basis of the net assets. However, to determine NCI on fair value basis, what I will have to do? See here. For 80%, we have acquired 80% of the share capital of acquiring company. Correct? And we have paid a consideration of rupees, how much? 960? Right. We paid a consideration of rupees 9,60,000. Are you getting my point or not? See here, acquiring company suppose is having 10,000 share and 1,000 share is of 100 each. Let us say having 10,000 share and 1 share is of 100. So logically 10,000 into 100, that is 10 lakh. That is the nominal value of the share capital. Presume that their total share capital is 10 lakh and number of share 10,000. Now suppose out of 10,000, if I am going to acquire 80%, that means 80% of 10,000 will be 8,000. So 8,000 shares if I am acquiring, so 8,000 into 100, logically it is 8 lakh. Logically it is 8 lakh. The nominal value is 8 lakh. But I am paying 9,60,000. That means I must have paid on fair value basis. So for 80% share, I have paid 9,60,000. Quite obviously, I must have made the payment on the basis of fair value. Suppose if I would have had acquired full 100%. For 100%, how much I would have paid then? If I had acquired all the shares 100%, then how much consideration I would have paid? How much consideration I would have paid? In that case, I would have paid 9,60,000 into 100 divided by 80. That is equal to 1, 2, 00, 000. I would have paid 12 lakh. If I would have had acquired all the shares, 100% share, obviously I would have paid 12 lakh. That means total fair value of 100% share capital of your acquiring company is 12 lakh. This 12 lakh represents fair value. It represents fair value of 100% share capital. 100% share capital of acquiring company. So now I am in a position to find out what will be the value of 20% stakes, 20% shares. So, therefore, fair value of 20% stakes, because NCI is having 20% stakes, will be equal to rupees 12 lakhs into 20%. Isn't it or not? That will be equal to rupees 2,40,000. So you have seen on the basis of fair value, NCI share is 2,40,000. When we computed on proportionate share of net assets basis, it was 160. So quite obviously now the difference in goodwill will take place. Now suppose if I compute goodwill, in this case what will be the amount of goodwill? A, 100% of net assets of 100% of net assets of acquiring. That is equal to 8 lakhs. Subtract B, NCI. Because this time you are considering NCI at fair value, which you have just computed. So you will write here 2,40,000. So it means out of 8 lakh, now 2,40,000 worth of asset belong to NCI on the basis of fair value. So whatever remaining will be acquirer share. Acquirer's share of net assets. That is equal to 5,60,000. Now compare it with the consideration. Now consideration is your 9,60,000. So you must have noticed in this case the amount of goodwill is 4 lakh. Amount of goodwill is 4 lakh. Now we can conclude two important points. Correct? Two important points. If NCI is valued on proportionate share of net assets basis, in that case we get goodwill, and in that case goodwill is known as partial goodwill. Partial goodwill. What does it mean, partial goodwill? I will let you know. And when we compute NCI on fair value basis, in that case the goodwill which we get is known as full goodwill. It is known as full goodwill. Now what is the replication of this full goodwill and partial goodwill? I will let you know. Ultimately, whatever goodwill we are computing, either through what we call PSNA approach or through what we call fair value approach, whatever goodwill we are getting, we will have to reflect it in the consolidated statement, group's statement as we call it. If I have computed goodwill on the basis of, as we did here, on the basis of proportionate share of net assets basis, in that case 3,20,000 worth of goodwill will appear in the consolidated statement, but this goodwill will be considered as partial goodwill. It means this goodwill is related only to the acquirer. This represents partial share, that means only acquirer share. Whereas this time, when I have computed the goodwill by taking NCI at fair value, in that case I am getting a goodwill of 4 lakh, and I will have to prepare consolidated financial statement. I will reflect it over there at 4 lakh, but this time it is not partial goodwill. This time it is full goodwill, in the sense out of 4 lakh, 80%, that is 320, is share of P, a share of acquirer, and 20% is share of NCI. That means full goodwill means in this goodwill there are stakes of both NCI and of course stakes of acquirer. That is what we mean by full goodwill. Now if you will look deeply, ultimately we are getting the same conclusion, because even in this case if I will compute the acquirer share, it will come to 320, 80% of 4 lakh. So it may appear to us that both are giving different results, but if we will read between the lines and go deeply into it, then we shall be able to conclude and infer actually both methods give us what we call similar results. Is it clear to you or not? So after having computed till up to this stage, now the next one is till up to this stage, then next question will pick up. In the next question 1.4, honestly speaking, rest of the question can be done by yourself easily, very easily, and should not be a big challenge. Okay, I will take 5 minutes of rest and then I will continue it. You in the meantime try to do this question of yours. So welcome again to this particular session. So I hope that in the meantime you must have tried question number 1.4 which I gave you. Anyway, your reactions are suggesting as if none among you have tried it out, but anyway, we pick it up 1.4. Herein what is happening, there is an entity by the name of Z Limited. Correct? Z Limited is the entity, and on 1/4/2022 accounting year must have commenced because it is given to us that on 1/1/2023 this company acquired 60% stakes and consideration is given this time is in cash. Consideration is in cash and it is 700 lakhs. 700 lakhs. Consideration is 700 lakhs, correct? And this company is acquiring another entity, P Limited. An accounting year must have ended on 31st of 3/23. Further, we have been given that on the date of control, net assets, in fact, we have been given this way around, assets of P Limited are having a fair value of 1,800 and liabilities are having a fair value of 900. 900, correct? Now in this question, we have to compute goodwill, of course. First of all, 100% of fair value of net assets of P Limited on the date of acquisition, on the date of control or date of acquisition. Assets are 1,800, liabilities is equal to 900, that comes to 900 rupees in lakhs. Correct? 900 less. Suppose if I deduct NCI and let us say on proportionate share of net assets basis. In that case, our share is 60%, so NCI share must be 40% and 40% of 900. That is equal to 360. We are left up with 540. 540, what does it reflects? It reflects acquirer's share. Acquirer's share of net assets, correct? We have to now compare it with the consideration. And the amount of consideration in this case is how much? Amount of consideration given to us was 700 lakhs. So 160 will be your goodwill. Now, you have been asked to pass the entry also. This time, assets and liabilities are written separately in the question. So my advice to you is that when assets and liabilities are written separately in the question, in that case, it is better to write assets and liabilities separately. 1,800 and liabilities 900. So that means now you have written the net assets 900. Now, you write here, first of all, NCI. NCI share is 360. By subtracting liability from assets, we get net assets. And now I have written NCI here. That means now net amount is reflecting acquired share. So basically now we are comparing acquired share with consideration. I can write cash also because consideration this time is in cash. 700. So the balancing figure will be goodwill. 160. This is how you are going to compute it. I hope most of you have done it. Now suppose if NCI is valued, suppose NCI is valued on fair value basis. NCI on fair value basis. Suppose, see here, for 60% consideration is, for 60% consideration is how much? How much consideration actually we are offering? For 60% we are offering a consideration of 700 lakhs. Now think this way around. If you would have had acquired 100% stakes, how much consideration you would have paid? In that case, you would have paid 700 into 100 divided by 60. Now this will be very clumsy figure, 1166.67 lakhs. This represents fair value of 100% of share capital of 100% share capital of acquiring company. Therefore, fair value of 40% stakes will be equal to 1167 approximately into 40%. That will give you 467 approximately. So fair value of NCI will be equal to 467. Obviously, in this case, your amount of goodwill will be different. 100% of net assets of acquiring, 100% of net assets of acquiring is equal to 900 less NCI. Now this time NCI is on fair value basis, that is 467. We are left up with 433. This shows the acquirer's share of net assets. Acquirer's share of net assets. Compare it with consideration. Consideration is 700 lakhs. Again, there will be goodwill, but this goodwill will be known as full goodwill or group's goodwill. It is known as goodwill. It is also known as full goodwill or group's goodwill. Because NCI is at fair value. Correct? Similarly, question number 1.5, now if I pick, in this question, what is happening? There is an entity. First, let me write the date, 14/11/23 and 31st of 3/2023. M Limited is acquiring 80% stakes on this date, correct? And as per the question, consideration agreed is 250 lakhs. 250 lakhs. On the date of acquisition, you have been given identifiable assets are 350 and liabilities are 50. Correct? It is given to you. In this question, it is given that NCI fair value is 43 and it is given. It is given in the question itself. Now, if fair value of NCI is given in the question, one need not require much mental exercise to know that this time you will have to compute the goodwill by taking what we call NCI on fair value basis. So now you have to compute the goodwill in this question. So you will write first of all 100% of net assets 100% of net assets of acquiry. 100% of net assets of acquiry on the date of acquisition. Given to us 350 are assets, 50 is liability, so 400 will be the value. Sorry, 300 will be the value. I have added instead of subtracting. 300 will be the value. Out of this 300, I will have to subtract now NCI share, correct? Less NCI. Now NCI is on fair value basis and the fair value is given to us. We need not require to compute it. 43. We are left off with 257. This 257 represents acquirer share. Acquirer share. Again compare it with consideration. What is the amount of consideration? Amount of consideration is 250. So we are left off with only 7. This 7 suggests gain on bargain purchase this time. Have you noticed? Because value of consideration, gain on bargain purchase, value of consideration is less than acquired share. So this will be considered as a gain. Gain on bargain purchase is nothing but capital reserve. Gain on bargain purchase is represented under the other equity item in the balance sheet. We will see later on. Question has also asked to pass the entry, so we will do this. Because assets and liabilities are given in the question separately, so in the entry it is always better to write them separately. 350, then you write liabilities to liability. Liability is 50, so we have written net assets now. First we write NCI. Out of these net assets, 43 belongs to NCI. So remaining assets are for acquirer. By writing here consider, we are comparing net assets of acquirer with consideration. Consideration is 250. So this time balancing figure is gain on bargain purchase. That will be equal to 7. Now if NCI would have been measured on proportionate share basis, in that case amount of goodwill would have been 10. Correct? So this is how you will have to do. 1.6, what does it states? 1.6. Here there is an entity by the name of Hansa Limited. (1123) acquired 70% stakes, correct? And this entity is taking over Nainital Orchards Limited. Nainital Orchards Limited. As per the given situation, this time consideration is 700 lakhs. And on the date of acquisition, 1,500 are your assets and liabilities is equal to 600. Liabilities is equal to 600. Suppose if I ask you to compute goodwill by considering NCI at fair value. Suppose if I ask you, nothing else is given in the question. NCI at fair value. That means you are computing goodwill by considering NCI at fair value. 100% of net assets of acquiry. 100% of net assets of acquiree, of course, on the date of acquisition. Rupees in lakhs. Rupees in lakhs. So what will be the amount? That is 900. Quite obviously 1500 minus 600. Less NCI at fair value. How you are going to compute NCI at fair value? You can compute it straight away. See here, we have got 70% stakes. And for 70% we have paid 700 lakhs. Now out of 70%, that means 30% stakes belong to NCI. Suppose if we would have had acquired only 30%, there is no need to unnecessarily lengthen it. Correct? You can straight away compute. For 70% consideration is this much. So for 30%, how much the consideration would have been? That is equal to 30 into 700 divided by 70. So that will tell you the value of NCI, fair value of NCI, and that will be equal to 300. Quite simple. Remaining amount is 600. This 600 represents acquired shares. Acquirer share. All you have to do is to now compare it with the consideration. How much is the consideration? Consideration is 700 lakhs, so consideration is higher in comparison to 600 worth of share. So 100 lakh will be our goodwill. Of course, it will be known as group's goodwill or full goodwill. It will be known as. Suppose if NCI is on proportionate share of net assets basis. In that case, it would have been a cakewalk for you. In that case, goodwill would have been 100% of net assets. That is 900 lakhs. Less NCI on proportionate share of net assets basis. In that case, I would have taken 30% of 900. That is 270. Acquirer share would have been 630. Acquirer share. $630. Then you would have compared it with consideration. Consideration would have been 700 lakhs. Amount of consideration is still more. So this time again goodwill, but this goodwill is known as partial goodwill. And partial goodwill means acquirer's share of goodwill. Acquirer's share of goodwill. Acquirer's share of goodwill. Is it clear to you or not? 1.6. I think you can easily manage this question. After this question, there is 1.7, 1.8, there is 1.7, 1.8. I will do 1.7 for you before I will give questions for homework. 1.7. What is happening in this question? First of all, pay attention here. In this question, we are acquiring 60% stakes and we are paying a consideration of rupees 2 lakhs. It is given in the question. Because we are getting 60% stakes, quite obviously NCI is 40%. NCI is 40%. And we have been given in the question, given fair value of NCI is rupees 1 lakh. It is given in the question. Now this question can be broken into some part. Part 1. As per this question, the demand under part 1 is, if net identifiable asset of D Limited, D Limited is acquiring company, of D Limited, actually in this question C Limited is taking over D Limited. If NIFA, net identifiable asset of D Limited, is equal to rupees 2,40,000. 2,40,000. Question is asking under part 1 that if NIFA of D Limited is 2,40,000, then compute the amount of goodwill. Question is asking us in this case that we have to compute the goodwill, compute the amount of goodwill by taking NCI, at fair value and on proportionate share of net assets basis. This is part 1 of the question, that if net assets of this company is equal to 240, then you compute the amount of goodwill by taking NCI at fair value and at PSNA. That means under part 1 we have to do 2 solutions. Just wait. Now coming to part 1, solution A. NCI on fair value basis, and fair value is given. So what I will do, first of all, I will write 100% of net assets of acquiry, which is equal to 2,40,000, it is given. 2,40,000. From there on, I am going to subtract NCI. Because I am taking NCI at fair value and fair value is given in the question, I will have to subtract 1 lakh. So I will be left off with 1,40,000. This 1,40,000 represents acquired share. This is acquired share. Just let me check whether the cartridge, it seems, right, still it is there, but I do not know why it's creating problem. Acquired share is 140. Again, we will have to subtract now consideration. What will be the amount of consideration? It is given clearly in the question, consideration amount is 2 lakh. Consideration is more. In this case, goodwill. This is known as full goodwill. Correct? This is goodwill, but this is full goodwill. Full value of goodwill or group's goodwill. B. Suppose NCI on proportionate share of net assets basis. In this case, 100% of net assets of acquiry, that will be equal to 2,40,000. Correct? Subtract NCI on PSNA basis, that is 40%. So 40% of 2,40,000 will be equal to how much? 96,000. I will be left up with 1,44,000. It will give me acquired share. Acquired share means acquired share of net assets. Now I will compare it with consideration. Consideration is 2 lakh. So in this case, we shall have again goodwill, but amount of goodwill will be equal to 56,000. So this was the first part of the question. This was the first part of the question, correct? In order to understand the question, there was a bit of problem. Solving is not a problem. Now, as far as part 2 of the question is concerned, now question states that if NIFA is equal to 3,30,000, if NIFA is equal to 3,30,000, then what will be the amount of goodwill if NCI is on fair value basis and on PSNA basis? NCI on fair value basis and NCI on PSNA basis. Now you can manage this question of your own, isn't it or not? A. NCI on fair value basis. %100% of fair value of net assets. Remember, now it is 3,30,000 less NCI at fair value, which is given in the question at 1 lakh. So we are left off with 2,30,000. Acquirer share. Less consideration. Consideration is 2 lakh. So in this case, we shall have gain on bargain purchase. Gain on bargain purchase. Gain on bargain purchase. In this question, we shall have gain on bargain purchase. Part B. NCI on proportionate share of net assets basis. 100% of net assets. 3,30,000. It's a formality now. Less NCI. Because you are computing NCI on PSNA basis, you will simply take 40% of 3,30,000. That will be equal to 1,32,000. So 1,98,000 in this case will be acquirer's share. Consideration. 2 lakh. Consideration is marginally higher than net assets. So again there is goodwill, but this goodwill is partial goodwill. So I hope after having done so many questions, you are very well familiar with concept of goodwill, NCI, and NCI at fair value and on PSNA basis. So this is how we have to go about in chapters of such strength and formidability. Of course, now we finish up this session and we shall meet you, of course, in the next one with something new. And in fact, in the next session, we are going to pick up a very heavy topic. I need not require to talk about that. Section 2, when you look into notes, you will come to know about that topic. Okay, then till then, it's goodbye.